Next, the cost of debt. Every company needs capital to operate and grow, and that capital typically comes from two main sources: equity and debt. When a company chooses to borrow money, whether through bank loans, bonds, or other instruments, it incurs a cost. The cost of debt isn't just the interest rate you see on paper. It's the effective rate a company pays to its creditors. And we'll learn why understanding this figure is absolutely critical for accurately valuing a business and setting its financial strategy. Let's dive into what the cost of debt is, why it's important, and how we calculate the after-tax cost. Before we define the cost of debt, let's understand why this figure is paramount in corporate finance. The cost of debt is not just an academic concept. It has four major practical implications for any business. Financial health. First, it serves as a critical indicator of a business's financial health. A lower cost of debt generally suggests the company is stable, creditworthy, and presents a lower risk to lenders. Risk assessment. Lenders, creditors, and investors use this figure for risk assessment. A high cost of debt signals increased risk, which can influence lending terms or investment decisions. Capital structure. It dictates a large part of the company's capital structure, which is the mix of debt and equity used to finance operations. Decisions on whether to issue more debt or equity are directly based on the relative cost of each. Valuation. Finally, and perhaps most importantly, it is essential for valuation. We use the after-tax cost of debt as a major input when calculating the weighted average cost of capital, or WACC. WACC is the standard discount rate used to value future cash flows, making the cost of debt indispensable for financial analysis. Now that we know why it's important, let's define and calculate it. The cost of debt is the effective interest rate a company pays on its borrowings, such as bank loans and corporate bonds. When we talk about the cost of debt in corporate finance, we almost always mean the after-tax basis. Why? Because interest payments are typically tax-deductible. This tax shield provides a substantial benefit, effectively lowering the true economic cost of the debt to the company. This figure is a true reflection of the cost of debt as a component of the overall capital structure. The calculation is straightforward, using this simple formula. After-tax cost of debt equals before-tax cost of debt times 1 minus marginal tax rate. Let's walk through the example of Banana QT Company. Banana QT has a before-tax cost of debt of 6%, which is what their lenders charge. However, they have a marginal income tax rate of 30%, or 0.30. Applying the tax shield to the cost equals 0.60 times 1 minus 0.30 equals 0.60 times 0.70 equals 0.42 or 4.20%. The tax shield reduces the 6% rate down to a true economic cost of 4.20%. This 4.20% is the figure we would plug into our WACC calculation. In conclusion, always remember to factor in that tax deductibility when analyzing a company's debt burden. We have previously discussed the cost of debt. Now, let's turn our attention to the other critical component of a firm's capital structure, the cost of equity. Unlike debt, which has fixed interest payments, equity comes with an implicit cost. This cost represents the minimum return a company must generate to satisfy the expectations of its shareholders and compensate them for the risk they take by investing. Understanding the cost of equity is vital because, just like the cost of debt, it is a key input into the weighted average cost of capital, or WACC, which is the cornerstone of corporate valuation. Let's define the cost of equity precisely. It is the required rate of return a company must provide to its equity investors to compensate them for the risk of their investment. Essentially, it is the compensation shareholders expect for owning a piece of the company. The formula is cost of equity equals next year's dividend per share plus equity appreciation per share divided by current market value of stock plus dividend growth. What are the factors that influence the cost of equity? The cost of equity is not static. It constantly changes based on the perceived risk by investors. We can categorize the major factors that influence this cost into 3 areas. Company-specific risk. These are factors unique to the company itself. Examples include financial instability, poor management decisions, or a lack of diversification in its product line or markets. High company-specific risk directly translates to a higher required rate of return for investors. Industry risk. This relates to the industry the company operates in. Operating in a high-risk industry, such as commodities, energy, or rapidly evolving technology, introduces systematic volatility. This can also lead investors to demand a higher compensation, increasing the cost of equity. And economic uncertainty. This captures the broader economic fluctuations and systemic risks that affect the entire market. Factors like high inflation, rising interest rates, or political instability increase the general perceived risk. When economic uncertainty is high, investors become more cautious and demand a higher risk premium across the board. In short, the higher the risk, whether it's specific to the company, the industry, or the economy, the higher the cost of equity will be. We've defined the cost of equity as the required rate of return for investors. Let's see how this works in practice, starting with a very simple scenario. Consider Masters Corporation, whose stock currently trades at 8 pesos. They pay an annual dividend of 20 cents per share next year. If we only look at the dividend, the investor's return would simply be the dividend divided by the stock price. 20 cents divided by 8, or 2.5%. But what if the investor actually requires a higher return? Say 5%. The company must provide that additional return, either through a higher dividend or through stock price appreciation. To reach a 5% return through appreciation, the stock price would need to appreciate from 8 pesos to 8.20. A 20-cent stock appreciation. Adding 20 cents divided by 8 equals 2.5% to the dividend yield. Alternatively, if the stock price remains at 8 pesos, the company would have to double its dividend to 0.40 pesos to meet the 5% requirement. Calculating cost of equity using CAPM. CAPM is the most widely accepted method for calculating the cost of equity because it ties the required return directly to the stock's systematic risk, or beta. Let's look at the data for Masters Corp to use the CAPM formula. Market risk premium, 4%. This is the extra return investors expect for investing in the broad stock market rather than a risk-free asset. Equity beta, for this stock, 0.60. This is the measure of the stock's volatility relative to the market. A beta of 0.60 indicates Masters is less volatile than the overall market. And the risk-free rate is 1,800 pesos. Applying the CAPM formula. The CAPM formula is cost of equity equals risk-free rate plus beta times market risk premium. Plugging in our values, cost of equity equals 4% times 0.60 plus 5% equals 7.4%. This 7.4% is the required rate of return, or the cost of equity for Masters Corporation, considering its risk profile relative to the market. Understanding further the beta. A beta of 1.0 means the stock moves exactly in line with the overall market. A beta less than 1.0, like our 0.60, means the stock is less volatile than the market, making it generally safer. A beta greater than 1.0 means the stock is more volatile and riskier. This brings us to the end of our presentation on the cost of capital, including the cost of borrowing, cost of debt, and cost of equity. The concepts we've discussed, from calculating the after-tax cost of debt to estimating the cost of equity using CAPM, are all critical building blocks in corporate finance and business valuation. On this slide, you'll find the references used to compile the information and examples for this presentation. We encourage you to explore these resources for deeper reading and further understanding of these core financial topics. On our assignment, or TLA, we're going to quickly analyze the Intel Corporation consolidated balance sheet, comparing the end of 2024 to the end of 2023. We will focus on three core areas: total assets, total stockholders' equity, and long-term debt, calculating the delta or change for each. First, let's look at total assets. We find this number at the bottom of the assets section. On December 30th, 2023, Intel reported $191,572 million in total assets. By December 28th, 2024, that figure had grown to $196,485 million. To find the dollar change, we subtract the prior year's value from the current year's value. Total assets delta equals asset 2024. Asset 2023 equals 196,485 minus 191,572 equals 4,913. This shows a positive change of 4,913 million in total assets, indicating growth in the company's resource base over the year. Next, we move to total stockholders' equity, the residual claim on the company's assets. This is a crucial measure of owner investment and retained earnings. In the liabilities and stockholders' equity section, we look at the very bottom line. Total stockholders' equity was $109,965 million in 2023. For 2024, it decreased to $105,032 million. The calculation for the change is total stockholders' equity delta equals stockholders' equity 2024 minus stockholders' equity 2023 equals 105,032 minus 109,965 equals negative 4,933. The delta is a negative 4,933 million. This indicates a decrease in total stockholders' equity, which is something investors would want to investigate further. Lastly, let's examine the change in long-term debt, a key component of the company's financing structure. Looking at the long-term liabilities section, we see the line item debt, excluding other long-term liabilities. In 2023, the debt stood at $46,979 million. In 2024, it was $46,282 million. Subtracting the 2023 value from the 2024 value yields long-term debt delta equals debt 2024 minus 2023. Debt 2023 equals $46,282 minus $46,978 equals negative 696. The negative result indicates that the company's long-term debt decreased by $696 million. A reduction in long-term debt generally signifies a reduction in financial risk and future interest obligations. Finally, we want to acknowledge the people who make this learning possible. This presentation was put together with the support and collaboration of our entire team. This is a photo of our team, including Doc Gold and our teammates Julianne, JJ, Christian, Renalyn, and Jackie, taken at PCU Maine. Their dedication and shared insights are what allow us to tackle complex topics like the cost of capital effectively. We appreciate their support and guidance throughout this term. We hope the examples and formulas we shared today help you navigate future financial decisions, whether they involve calculating the true cost of borrowing or estimating the cost of equity for valuation. Don't forget to like and subscribe on our team YouTube channel, www.youtube.com/thepcumba Masters. Thank you very much for your time and attention.